Hello and welcome to the business edition of PM Express with me, Philip Nanfuri. Now, on Monday, the Monetary Policy Committee of the Bank of Ghana had its 91st monetary policy press conference, and in the key issue that came up was the staying of the monetary policy rate at 16%. Now, in there also, the Governor of the Bank of Ghana, Dr. Ernest Addison, discussed a number of key policy measures which they argue is going to help with the issue of lending rates in the economy. And atop this was the enterprise credit scheme, which the finance minister announced in the 2020 budget. And the governor says they're going to take 2% of the primary reserves of banks. And this fund will sit with the Bank of Ghana. And if banks are part of that scheme, they'll come and access these funds. He also said they are thinking of proposing a minimum loan to deposit ratio. We'll get more explanation on that in the course of our discussion. Another important part that came up was the aligning of compensation of management of banks and the board, I beg your pardon, to the bank's performance. So simply, if your bank is doing better, you can reap your fat salaries. If it's not, you shouldn't be earning so much. Why should the cost of management, salary, etc., have an impact on lending rates? We also learned that. Then in there also, he spoke about the risk premium, what banks add when I come for a loan, when you go for a loan. What are your specific factors that add to the risk of you as a borrower or your credit profile? We'll also explore that. Then we'll look at our debt numbers, and if there's time, we'll delve into the Afrobarometer surveys. We'll just dig into them and see what we can learn there. And to help me walk through all that, Nana Otu Champon, banking consultant. He's to my left, and to my extreme left is Professor Eric Osei-Asibeye. He's an economist, and he's with the Department of Economics at the University of Ghana, Legon. So we'll be delving into the issues. We'll start off with the banking ones, obviously, and then we'll go on to the debt numbers, and then we'll wrap up, if there's time again, with the Afrobarometer report. This is the business edition of PM Express with me, Philip Nanfuri. We'll be right back. Right, you're welcome back. Without further ado, I want to jump straight into our discussion, and I'm going to start off with Nana Otu Champon on this one. So, Nana, average lending rate in the economy, according to Bank of Ghana's Summary of Economic and Financial Data, is 23.65% as at October 2019. If you look at gross credit, private sector credit, as at August 2019, from the banking sector report, it's about 35.155 billion. Now, I look at all the measures they've put in place, and I ask myself, isn't this the regulator interfering with what's supposed to be a free market? And the governor himself mentioned other things that are inhibiting the low lending rates. He mentioned the high NPLs and government's appetite for domestic borrowing. Shouldn't we fix the other things before we start instituting such measures? Or we fix these things and the market itself will allow the lending demands and supply to flow?
Yeah, I think the latter more than the former, in the sense that in the free market, you allow prices to find their own levels, and therefore you only come in if there's an externality. And in this case, a couple of externalities have been identified, and that's why they are coming in. To help enterprise credit, normally loans are given to one of two sectors, either to the public sector or private sector. And presently, the trend is that the banks are moving to giving out loans to the public sector through the acquisition of treasury bills. Partly, in my view, because of the new capital requirement directive, that if you give to the private sector and there's a non-performing loan, it hits your capital and you go to find more capital to replace. Yeah. But if you give it to the public sector, which is buying treasury bills, because it's zero-rated risk, it means that you are home and dry. So that's where they're moving to. So these moves, for instance, the Ghana Development Bank is one way of
the National Development Bank.
Yes, yeah. The National Development Bank. Yeah, that the Minister of Finance indicated in the budget. Sure. That is a way of trying to help specific sectors of the economy with cheaper loans, you know. Then secondly, this 2% that is going to be peeled off the primary reserve of 10%, which comes to about 2 billion. I mean, the exact amount is 184 million. But this is also to help credit go to the private sector, because presently, if the average lending rate is 24%, and the MPC rate is 16%, then you see the gap there, the 8%. So a way of bridging that gap. So I think this is a necessary intervention because of the externality to try and get the system working, but especially lending to the private sector, because that is the engine of growth, as opposed to giving it to the public sector. So I think they are necessary.
You think these are good measures that will help? Let me come to Prof. Asibe on this. Prof, he mentioned the National Development Bank, and I remember I sat in your class and we discussed financial repression, where there was a time where government-owned banks, credit rationing, interest rate ceilings came in because government had a high stake in the financial sector at that time. Times have changed, but would we be wrong in saying that this National Development Bank can toe that line of giving loans to entities that are not worthy, and that further builds this non-performing loans we talk about?
Well, I mean, it depends on how it is set up. I mean, if you get the starting wrong, it could easily lead to that. So largely, I think it's a good initiative, as Nana said, because it's going to make available much more affordable and long-term financing to businesses and firms to be able to access long-term capital. But then it will all boils down to the ownership structure that they intend to have, whether there's going to be a good corporate governance system in place, and the management system that ensures best practices in terms of banking. If that is the focus, then of course we can say that it is not going to repeat the mistakes of the past, in that the focus is going to be more on embarking on best practices, good corporate governance system, ensuring good management, ensuring that there's risk mitigation policies, and then effective liability management, effective asset management, and all the good things that goes with banking principles. If that is the case, then I think it's a good thing that they're going to bring, because one of the key issues that we've had, you know, our capital market is not well developed, and people often don't patronize. Firms often are not able to raise much more long-term financing, and the banks are also quite reluctant to lend on long-term basis. They prefer, as Nana said, to lend to government, which is a safe haven for them because the risk, the default risk probability is very low, and therefore they always will prefer to give to government. And given what is happening within the bigger real sector and the macroeconomic environment, they will not be willing to give out funds for that long-term basis. But that will mean that businesses will not be able to access long-term finance to invest in the critical sectors of the economy. And for the finance and the real sector, the only connection is having access to credit. Right? So if your financial sector is booming and businesses don't have access to affordable long-term credit, it doesn't often, result in your real sector increasing or your growth increasing. So then you see some kind of disconnect, and that has been a problem for this economy. The reason why businesses are not able to compete and to penetrate into the global value chain is the fact that the cost of credit is very high, and their inability to get access to long-term finance, which is not the case in many other comparator countries. So if this bank is going to be well focused, is going to be well managed, and be able to pick winners of enterprises and ensure that such enterprises expand, grow vertically, and are able to penetrate into the global value chain, that is a first step. So it's not just coming to throw out money and thinly across. It should be able to pick winners and support bankable projects, so that in the end we can have Dangotes and Samsung, big businesses across. It's key. So I am more keen on the way it's going to be set up, the governance structures that are going to put in place, and who is going to be asked to manage such organization, the board of directors and all of that.
Okay.
It would tell how it's going to behave.
Let me come to you quickly before I come to Nana on one of the measures that the Bank of Ghana outlined. The use of the 2% primary reserves. The primary reserve ratio is 10%.
Yeah.
Right.
So of every deposit, 10% goes to the Bank of Ghana for monetary policy reasons. If we are bringing back this 2%,
right,
I don't know if my question is wrong. What is going to be the possible impact on the monetary policy or the inflation target? Because the 10% is knocked out of the system for a reason.
Yeah.
Now we are bringing 2% out of that back into the money supply system.
Yeah. So the first effect, of course, is an expansion. Sorry. It's an expansionary monetary policy because then you are reducing the primary reserves, okay, by about say 2%, okay, and then allowing banks the freedom to lend the extra 2%. It is not a secondary reserve like we used to have where there's a secondary reserve ratio. This the emphasis on the primary reserve, which to me is good because you are targeting the same reserve. The good thing about this initiative is the fact that it is a targeted initiative.
Okay.
You're not just allowing the banks to give out credit to any person, to household for consumption, and to, which can easily lead to inflationary pressures. And so if it's going to be targeted and it's targeting at the productive sectors of the economy, then it can insulate any inflation pressures that might result out of it. So if it's going to be channeled in that way, then we can say that immediately it can result in some level of liquidity expansion. But over time, as the productive base of the economy expands, it will absorb it, which will not make it that inflationary.
Okay.
And so for me, the targeting aspect is key. And the fact that it's targeting the productive sector of the economy, the SMEs, which are going to increase production and employ more people, and then increase income generally, and which then propels growth, which for me it is a good sign. And it's also one way to bring in interest rates down, because once banks, you reduce the reserves, you give banks more funds to be able to lend out, and the banks will be forced to look out for businesses to access these funds, which then force the lending rates down. So that is one of the ways that will bring the lending rate down. So talking about that will then be the other ratio, the loan to deposit ratio that they increase. I think it's also a lofty idea, really, because I mean, we've seen that in several other countries. Nigeria has one. Currently doing Indonesia has one, the loan to deposit ratio. Now, the good thing about this loan to deposit ratio, if you have the threshold, it helps us to know the extent to which banks are giving out loans. Okay. So because if the loan to deposit ratio is high, it means that banks are giving out more loans. But then it also means that there's less liquidity, because if it's about 90%, it means that 90% of your deposits are going into loans. But it may not necessarily be the case. Another thing is, if it's high, it may also mean that banks are not collecting enough deposits. So if the base is low, you can still have a high ratio. Okay, but not necessarily you giving out more loans, but it's because you are not mobilizing enough. And so the ratio will still be high. Okay. So it's one ratio that can, if the threshold is set or the minimum threshold is set, it's going to encourage banks to give out loans, and at the same time encourage banks to mobilize, to increase their deposit base. Because either way, you fall short of it. If you advance too much loan to meet the threshold without expanding your deposit, means that you are not being prudent in your liability management. And if it is too low, it also gives an indication that banks perhaps are holding on to their deposit, keeping large excess reserves and not advancing loan enough, which now is the case. Many banks are sitting on huge deposits, and they are unwilling to lend or not even lending to government. And I think that they have to make that distinction. not just loan. I think it should be loan to the private sector to deposit ratio.
Okay.
I think that will really help to advance more credit to the private sector in that regards.
Now hold on for me. I have two infographics. A colleague of mine by name Alfred Appiah put together for us to display to you. The first one is a bar graph that shows our banking sector, this loan to deposit ratio over time. I want us to look at that one first, and you see there that in August 2016, our loan to deposit ratio was 76.6%. So if you follow Professor's arguments, you realize that at that time, more or less, so for every 100 Ghana cedi received in deposits, about 70 Ghana cedis will go out as a loan. Then, when we went into August 2017, it dipped. That was when we started this banking sector reform. It came down to 69.5%. Then in August 2018, it dipped further to 49.9%. And if you follow Prof's arguments, you see that so they were doing less loans with their deposits. Then it picked up again to August 2000. It picked up again, I beg your pardon, to 51.1% in August 2009. Now, Champon, given the numbers that I've just gone through, and I've put it right here for your viewing pleasure, what do you make of this policy? Because BOG said they want to explore it with the Ghana Association of Bankers. I read two stories from Bloomberg, which were follow-ups to the Central Bank of Nigeria's implementation of this. And big banks were fined. Some of them have their subsidiaries in the country here. It spared no expense. It went all out. And there was another story just this week that says that the manufacturing sector is the biggest beneficiary of this because the banks have enforced channel funds there. Nana, do you think if they agreed, what would be a good ratio and what would be this impact for the Ghanaian economy if BOG and the Ghana Association of Bankers decided that we are going on with this?
Well, at the moment, as you rightly said, it's exploratory because the central bank said they haven't made any firm decisions on that. They have to discuss with the association to see whether they will buy into that. But earlier on, you said that in a free market economy, these prescriptive issues do not help. And trying to set a benchmark, L to D ratio is one of those. In the free market, allow the banks the freedom to lend as they like. Now, we know when, say, Baroda was here and they were sticking to the treasury bills, we were asking, were they doing banking?
Most profitable bank.
Of course, they were doing banking because they were lending not to the private sector, but to the public sector. And so it was banking. So we have to wait and see the outcome of the discussion. But in my view, this is not an externality that I would require regulatory intervention. I will leave the free market to determine what it should be. I don't know the outcome of the Nigerian exercise because it hasn't gone for long.
Yes, it hasn't gone on for long.
A similar thing is on interest rate, to say you are capping interest rate. And there has been calls. Kenya started it. And then all knew that it won't work because it's against the free market. If you are in a communist regime, then you could be setting those sort of things. But in a capitalist regime, it is wrong to be doing those sort of things.
True.
So I wouldn't put too much weight on this one. Rather, I'm more interested in this reduced interest rate that would be got through the 2%
of the primary reserves.
Now, the interesting thing is, this one is not going to be given to the banks. I think Prof thought that the 2% will be no.
He mentioned that the banks will be part of the scheme and then they will have access to it. Just like the governor said.
It will be at the Bank of Ghana.
Yes.
And then if you bring a bankable project, and they evaluate, and then they will.
He made that in his
yes. So I think that one is something that is good because, in fact, the banks did call for this. They said, well, you're asking us to reduce interest rate. If at the moment 10% of our money is sitting there and then there's nothing, then give us some back then it will allow us to reduce our rate. So I think the 24% by the next MPC by January,
we should see some reduction
coming down. You know?
Okay.
Yeah. So I think it's a good exercise.
Prof, please.
Yeah, just to add to the RD, the LDR, the loan to deposit ratio. Yes. Well, it may not necessarily be a control or regulating the banking sector, particularly if you set it within a particular band, a lower band and an upper band, you know, so that the banks will still have some degrees of freedom, you know, to operate within that band. So maybe a minimum band could be, say, 70% of a ratio, and then the upper band will be 90%, so that you guarantee 10% liquidity within the banks. But then what that means is that banks will not be lazing around, so to speak. That one, you have to force to maintain certain ratio, which means that if the deposits are coming in, you are forced to lend money out. That is intermediation.
It's switch sector.
Yeah, to the private sector. That's what. Yeah, that's why I said initially that it would be better to disaggregate, you know, the ratio, so that the ratio loan to private sector over deposit ratio. So that there's a constant proportion between your deposits mobilization and your lending. So if you are increasing your deposit base, then you are forced to increase your lending base to the private sector. In that way, the banks will increase their intermediation processes, not just, you know, lending money to government and sitting back and making huge profits, but then they will be required to also intervene in the private sector and then help the real sector to expand. So in a way, it will not be good if they set just one ratio. If it's a band, you know, lower and upper band, then it gives some level of flexibility for the banks to operate. But on the whole, I think it has worked for some countries like Indonesia and others, where these indicators help the bank to assess their own effort and their own liquidity performance.
I want us to take, just a minute. I want us to take our last infograph, prepared again by the same gentleman, Alfred Appiah. That one shows from June 2014 to June 2019. And that one is a line graph. It's going to show us how this loan to deposit ratio has worked over a course of 5 years.
Did you do that for the private sector?
And
private sector loan?
No, this is just from
total.
Yes, total loans. As it is in the Bank of Ghana's banking sector report. So you can see that over the course of 5 years, you see on the line graph how it depresses and goes down. You see it was in highs in 2015, and then it goes down all the way to 2019. So just to give you a pictorial understanding of what we are discussing. Nana, you wanted to make a point before?
Yes, it was about the private sector lending. I think in the governor's presentation, he identifies some of the factors that are going against the banks lending to the private sector. The recovery process. You know, you lend, the loan has gone bad, and then you go through reclaiming through the courts, and for 10 years you'll still be going in and out of courts, you know. So those are some of the reforms that he anticipates will be able to clean the system. And when you do that. Now on the Appiah's infograph, I don't think there's any price in there for knowing that the loan to deposit ratio is going down. This one.
Yes, this one.
The credit.
It was just
the credit.
Yeah, if you look at it right here on my tab, you see that it's at as of June 2015, 80%.
That's when irresponsible lending was.
2015.
So it may also not necessarily be the case. It could also be that the deposits were smaller. Because the ratio. So if the deposits were smaller, it could still have. You could still record a higher ratio. You know, so
the interesting part is here. This is where the banking reform.
So you can really assess the impact.
It's expected that it will be like that. You know.
But talking about the lending rates that the banks charge, I think really, you know, recently we had the banks recording huge profits, right? And I think that one of the key, the underlying factor is the fact that the interest payment or the interest cost versus the the interest income, the spread is very high.
Yeah.
You know, which means that, like the central bank said, the bank appears to be passing on their inefficiencies to the private person by increasing the risk premium, the profit margin on loans, and all of that. So one way of reducing the lending rates critically is how to ensure that the banks, you know, operate much more efficiently, particularly with regard to their operational costs. Remains high. The amount of money, as they said, they pay.
I like where you're going with this, Doc, because I was coming to that.
Okay.
Sorry to interrupt you, and let me just ask you this, and you continue to submit this, and I'll come to Nana. So, I do understand what the Bank of Ghana is saying, but I have to pretend like I don't.
Yeah.
How will an MD's salary compensation board affect the lending rates? Why should we be concerned about the funds these people who have worked so hard and are managing risk?
Before you go further, please try to understand what the governor said.
Okay.
He didn't say he is going to set rates for salaries or compensation.
True.
But he wanted transparency.
Transparency.
That's all. Because in a competitive market, it's transparency that, you know, is going to show the efficient away from the inefficient.
Yeah.
And therefore, what they wanted was transparent disclosure so that people know Bank A and Bank B, what is the compensation package for the board, key management personnel, and the executive versus Bank B, and see relative to their performance, how is it like? You know, because some of the banks that collapsed, these were some of the problems that
they were earning
exactly the relative, you know, the ratio between what they were earning and the performance were just apart. They were not converging. So the transparency trick, I think, would do some of the job.
But Nana and Prof, for us, the public, as we're looking at this, we'll be excited to hear and see what our various bank MDs are earning, because until you are in the industry, you never know what's going on.
You aggregate.
So the key question here is that, from your arguments, and I see Prof was nodding, it will help from the transparency point of view.
Right.
But for the bankers, will they be happy? Given our cultural context, we need to factor it into the discussion. Our cultural context. In the US and the UK, it's published. Jamie Dimon earned over $23 million last year. We know. Ghana is a different case. Will the bankers be happy? I want to start with Prof.
No, but I mean, if the president's salary is announced, and
why shouldn't the private man?
Why shouldn't the private
but then
man?
It's a function of their shareholder. Shareholders put the capital together, they form the bank. Shareholders appoint board, board appoints management. They are answerable to their shareholders.
Well,
yes.
Yes,
so
I mean now,
they're answerable to their shareholders.
With the new Company Act and all of that, we're moving into a situation of full disclosure, you know, in businesses. And therefore, there's no longer a situation where you can put things under the carpet and, you know, assume that everything is fine. You have to be as much transparent as possible, and you have to be able to disclose all important information. Even with the RTI and others coming, you can sit here and still, you know, demand such information from boards and banks. So I think it's a good step, so that people don't abuse, you know, the system. Particularly when, as Nana's saying, you are in serious liquidity situation, you are incurring cost losses, and then you are paying so much. You know, eventually it affects you and I, because you know it goes into your operational expenses. You know, and once your operational expenses is high, if you look at the base formula, in a way it gets into the interest pricing. You understand? So it goes into your costs of delivering a financial service, which then eventually pass on to the retail lender or borrower. So it's something that I believe that it will streamline the process. The transparency will make sure that there is some kind of consistency in pricing, and the central bank can also monitor whether you are abusing or you are not abusing the situation. So for me, it's good. And that's trying to bridge that gap between the interest costs, the interest expense, and then the interest income is key. to ensuring efficiency and also to bringing lending rates down.
Right.
And the only way we'll be able to know that is if we know what goes into the interest expenses and then the operational costs and all of that, so that we know whether a bank is taking advantage of the people or not. So, for me, I think it's a good start.
I would take it from both of you that these policy measures, if they are crafted properly, they would hold and help with dealing with the lending rates.
Yeah, it will help, obviously.
We are all in agreement. Yeah. Fantastic. Okay, I want us to move to another part of our conversation. Prof, I'll start with you because of your interests and then your profession of economics. Our debt numbers. We've had this debate over and over again, and I stripped up the data from the Bank of Ghana Summary of Economic and Financial Data. And arguments have been proffered as to whether the debt is as a result of, our increase in debt stock is as a result of depreciation of the Ghana cedi or borrowing more or a combination of these factors. Let me put these numbers into perspective. As of September 2009, total debt in dollar terms was 39.2 billion. It went up from 35.8 billion over a course of 1 year. Total debt in Ghana cedis, as at the same September 2009, was 208.6 billion, up from 170.8 billion over a course of 1 year. The debt has gone up by these figures, 37.8 billion. External debt is making up roughly 107 billion Ghana cedis, and domestic debt is making up 101.4 billion Ghana cedis. Debt to GDP ratio 60.3%. Prof, when I look at the numbers and I take the external debt only, from the numbers only, it's gone up by $2 billion. But in cedi terms, it's gone up by 20.6 billion. Our debt numbers, if you look at what the IMF is saying, I recently read something where they said the frontier and emerging economies like ours have been on a debt binge since the financial crisis, but now we seem to be tapering off. But however, the risk of vulnerability remain high. What is the issue with our debt numbers? Is it just what we are borrowing? Is it the depreciation effect? How do we understand the numbers now?
Yeah, yes, our debt stock is definitely a concern. It is growing from about 170 billion last year to about 208 billion thereabout. But I often will not look at the magnitude or the levels of debt, the debt stock, because sometimes it can be misleading. It doesn't tell the full picture.
Okay.
I mean, we have countries that have, have huge debt levels, debt overhang than we are, but the IMF and others are not complaining. Yes, I think the key issue is a country's repayment ability, when you're doing the assessment. And of course, because the debt levels, exchange rate alone can increase your debt levels, right? And then if you look at also the way the debt levels increase, so long as you are recording positive deficit, your deficits is increasing, definitely you have to borrow to finance it. And given what also happened in the banking sector cleanup, which added about 11.8 billion or so, yes, definitely you see your debt levels going up. But the key issue is, what is your repayment ability? And the repayment ability, one, you need to look at the debt structure. What is the debt structure? What percentage of your debt are in short-dated bills, and what percentage of your debt are in long-dated bills? Because if you are able to restructure the debt profile in a way that puts a large proportion of your debts into the long term, then really you don't really have to bother so much, because it gives you that latitude to pay back over a long period of time. And so I like what is happening in recent times, that even though the debt levels are increasing, the debt structure, the composition, the maturity period of the debt is changing. It's, it's so becoming much longer. Long-term borrowing, yes. And the other key factor that is also important is to look at, what are you borrowing the money for? If these monies are going into infrastructure projects that are self-financed and that can pay for themselves, then of course it's a good thing, because you need this infrastructure project to sustain your growth momentum over a medium to long-term period. And so what matters most is this borrowing amount that you're borrowing, are they going into like road infrastructure? Are they going into health care provision in terms of infrastructure and all the things that are needed to support your growth levers over a long period of time? It is critical. The other thing that is also important in terms of your capability to pay is your interest payments to your tax revenue. It's key because that gives you whether you are mobilizing or collecting enough revenue to service the debt when they are due and to pay the interest on it. And so that is why the issue of revenue becomes critical. Yes, because if you are generating enough revenue, then you don't really have to bother whether you are borrowing, because you know that over time you'll be able to pay the interest, you'll be able to pay the principal over a period. So it becomes a concern if you are not mobilizing, if you are not generating enough revenue in that regard. So we shouldn't be so much concerned about the debt levels. I think what we should be concerned about is our revenue generation capacity, which then helps us to repay the loan, and also ensuring that the monies that are being borrowed are being channeled into the productive sectors of the economy, because otherwise all countries borrow, so we cannot say that we are no longer going to borrow, but we have to make sure that one, we are improving our repayment capacity. The economy is expanding enough that is providing us the capacity for us to repay this loan over a period of time. Otherwise, I think
this is the business edition of PM Express with me, Philip Nanfuru. You just heard Professor Eric Osasibi. He's an economist, and Nanotu Champon, bank consultant, is also in the studio. When we get back from the break, we're going to delve into the ECD. What exactly does it mean? Nana will share something briefly with us. Then we'll move into this Afrobarometer survey that looks at the confidence in the financial sector, and then we'll wrap up our show. We're taking a quick break. We'll be right back. You're welcome back, and this is the business edition of PM Express with me, Philip Nanfuri. I want us to jump straight to the discussion on electronic cedi, or the ECD. And let me just quote what the governor said in his speech. The central bank is in discussions with key stakeholders to explore a pilot project in a sandbox environment on central bank digital currency, with the possibility of issuing the ECD in the near future. And Nana, when we talk about electronic cedi, what exactly are we referring to? Because it seems we already have that operating.
You already have that operating, but who owns it? At the moment is the telcos who own that, know, and this Section 10 of Act 987, which is the Payment Systems and Services Act, gives the banks the permission to apply for a license to be allowed to issue e-money. The e-money, all it means is just like your MTN Momo or Vodafone Momo that you have. It has to be backed by cash, so that if 1,000 cedis is transferred, you should have the ability to pay the 1,000 cedis if I want to draw it in cash. But alternatively, I could keep it in my wallet for as long as I want, and that's what's happening. So GCB has been the first one to be issued a license for that. I suspect the other banks may also want to do that, because if the Act gives them the permission, then they should get on with it. What it means is competition is coming in, and those are some of the objectives of the regulator, because competition can only be good rather than bad for any system. So the monopoly, or you could call it oligopoly, that these three telcos now, the banks are coming in, and the banks are 23. So therefore, it started one, so I think it's a good thing. And it links out with the Afrobarometer that you want to show, because now you see in terms of trust that people have after the banking crisis, as you can call it, the Ghana one. At the top is the banks. That's the institution that people trust most. Then the second is telcos, the mobile money operators, which is surprising, because if you take the deposit-taking sector, there are 5 sectors. You got universal banks. Next to that is savings and loans, finance houses, rural banks, and microfinance. Now, they didn't pick any of them, and they picked mobile money as the second most trusted.
Yes,
so it is good if the banks are not.
And we have it displayed on the screen there for you. That's from the Afrobarometer survey. This one focuses on the financial sector, and this part focuses on confidence. This is post the financial sector reforms. And the report or the survey is saying that from the respondents surveyed, 58% of them think banks are very safe. Then the next one, 25% somewhat safe, 8% not safe, and then 7% not at all safe. Then you have the next one being mobile money. And I was telling Prof before we came on the show, and this is where I'll bring in Prof. Mobile money funds sit in the accounts of banks, yes or no? Yeah. So, Prof, what do you make of this Afrobarometer, this thing, about the confidence in the financial sector? That Ghanaians believe that, or Ghanaians was what was used here, or I would say respondents believe that 58% of them believe that banks are very safe.
Well, I mean, confidence in banking is everything. If people have trust in the banking system, then it encourages financial intermediation. It deepens the process of financial intermediation. So I'm happy to learn that the confidence within the mainstream banking system, is picking up, and this is quite positive for that. But at the lower end of the market, it's quite scary. I mean, that is where the actual things happen, where people have access to microcredit and they're able to finance their small businesses and others. So the mobilization at that lower end is key, for the expansion of these economies. And so if people are not getting having trusts and confidence within the micro enterprises and its, the social operations and others, then it's really worrying. If you look at the third one, which is, I think, is home, which means that really people have more confidence in their money at home, stashing them under their pillows, and that really is a leakage to the income flows and to the intermediation process. So we really have to look at that lower end. It might also be that, this survey might have coincided with the time when the central bank was cleaning up the microfinance and savings and loan subsector. And therefore, at that time, that negative publicity, was there. And so that might also, it could affected the responses of the respondents. And so, but albeit, I think the central bank has to look at the lower end of the market because it plays a critical role in ensuring that there's financial inclusion in the financial system. And so, if people are losing trust in that level, it could channel funds away from the banking system into their bedrooms and others, which does not help in terms of credit expansion and then having access to loans.
No, on that point, the central bank is really helping with the financial inclusion because, for instance, if you take the deposit-taking sector, I listed them, and the fourth one is rural banks. Now, in this cleanup exercise, rural banks have not been touched.
Well, but maybe they will be touched. It's done. Is it done?
It's done.
It's done. Because every year that credit union and others will go
up to the end of February to get their minimum capital of 1 million. As we speak, about 80% of them have it. Only a small fraction. And those who will not have it, help will be given to them to have it. Because they play a very critical role. Where they have their branches, no universal bank or even savings and loan will go there, in the villages. So financial inclusion is being encouraged.
At that level.
So, gentlemen, as we wrap up on our conversation, what are our key takeaways from this conversation? We've looked at, most importantly, the policy measures that are supposed to boost credit. And BOG mentioned the issue of the transmission mechanism. At some point, people were asking if the transmission mechanism was broken. Then Ghana reference rate came inside, and we're seeing some pickup. But I think they want to jig it a bit. What are our key takeaways from this? Prof, I'll start with you. 1 minute for you, 1 minute for Nana, then we wrap up.
Yes, I think the key takeaway for me is the fact that the credit environment is gradually improving, and the fact that central bank is intervening in the credit market, because that has been one of the bane for this economy. Although we are seeing improvement in the macroeconomic environment, it is not translating much into the real sectors of the economy, and therefore this is a sure way of ensuring that the improvement at the macro level translate into the micro level, where there's access to finance for businesses to, expand their business and employ more people, and therefore increase income and grow the economy. And therefore, it's a key intervention that the central bank is putting in. But be it that it may, I think the central bank, government, and then the banking sector themselves must work harder to speed up the process of reducing the lending rate. I think gradually the gap between even the inflation rate and then the lending rate keeps widening. Now we have inflation rate at around 7.8%. Yeah. Policy rates still remain at 16%, and lending rate hovers around 24%. This gives a gap of about 2,000 basis, 200, or should I say, 2,000 basis points, which is huge. And therefore, the central bank, even the policy rate, often in many countries is around 500 basis points. But for the policy rate now, it's getting to about 1,000 or so basis points. So there's a need, the responsiveness of the policy rate to inflation is weakening by the day, and we have to really work to close that gap as much as possible.
Good one there.
Yes, to make sure that lending rates come down.
Okay. Nana?
Yes, I think the title of the program, has been proven, boosting private sector credit, and the measures that are being taken by the central bank are ways of boosting that credit. As I said earlier, I'm excited about this 2% special rate that is going to be given to SMEs, and also the National Development Bank, which will also be targeting special sectors, because our great sector has been crying. I know you guys have been saying we should eat Ghana rice, and they complain that they don't get credit to do this thing. So I think it's good. Yes.
Nana, thank you very much. This has been the business edition of PM Express with me, Philip Nanfuri, my guest, Professor Eric Oseasibe. He's an economist, and Nana Otu Echampon, banking consultant. I want to say a big thank you to all of you for your time, and from us here, it's good night.